Hello everyone, and welcome to Virginia International University's MBA 603 Contemporary Issues in Accounting. Today we're going to pick up with Chapter 4, where we talk about consolidation techniques and procedures with respect to preparing financial statements. You may recall that in Chapter 1 we talked about business combinations and mergers and acquisitions and kind of set the stage with clarifying terminology and in order to help us understand the activities and the results of those activities with respect to organizations, mergers, acquisitions, combinations, and then we proceeded to discuss how we account for these transactions. In Chapter 2, we focused on equity investments in which the investor maintains the investment account on a continuous basis. It included accounting for investments under the fair value or cost method, in which the investor does not have the ability to influence the activities of the investee, as well as accounting under the equity method of accounting, in which an investor can exercise significant influence over the investee's operations. You may recall that GAAP, Generally Accepted Accounting Principles, generally prescribes equity method accounting for investments that represent a 20% ownership through a 50% ownership in the investee. Or investees use the equity method for internal parent control accounting for investments in subsidiaries. They use this when the investor controls the operating, investing, and financing decisions of the investee through ownership of more than 50% of the voting stock. So in Chapter 3, we went on to discuss the introduction to consolidated financial statements. The required consolidated financial statements include a consolidated balance sheet, consolidated income statement, a consolidated retained earnings, or consolidated statement of changes in stockholders' equity, and a consolidated statement of cash flows. These are generally the standard financial statements required to report the results of operations. And so that's what we discussed in Chapter 3 and had an overview of these consolidated financial statements. In this chapter, we'll talk about how to prepare consolidation work papers for the year of acquisition when the parent uses the complete equity method to account for its investment in subsidiary. We'll prepare and walk through a consolidated work paper for a year subsequent to the acquisition. We'll talk about how to locate errors in the consolidation work papers, and we'll talk about how to record fair values to identifiable net assets acquired. So let's start with the preparing the financial statements in the acquisition year work papers. And so we want to keep in mind that numerous consolidation approaches and any number of different adjustment and elimination combinations will result in correct amounts for the consolidated financial statements. The adjustment and elimination entries that appear in the work papers do not affect the general ledger accounts of either the parent or the subsidiaries. Adjusting or eliminating accounts or balances simply means that the amounts listed in the separate company columns of the work papers are either adjusted before inclusion in the consolidated statement column or eliminated and do not appear in the consolidated statement column. And so there are several steps to completing the worksheets that we've been talking about. First step is to enter the parent and subsidiary amounts on the worksheets at 100% of the book value, even if the parent owns less. Secondly, we enter the elimination entries into the debit and credit columns, and these elimination entries come about as a result of the analysis of certain transactions. Then for consolidated revenues, liabilities, and equity, other than for ending retained earnings, we add the parent account and the subsidiary balances, less any debit or plus any credit balances. And then to get to our consolidated assets and statements, we add the parent and subsidiary again, plus any debit, less any credit balances. Next, then, for income, we take the ending retained earnings and all subtotals and totals and compute directly in the consolidated column. And just keep in mind that while we're doing this, that the total consolidated assets should equal the total consolidated liabilities and equity. And this is our age-old accounting formula, as you all recall. Assets equal liabilities plus owner's equity. And so that doesn't matter if we're talking at a parent level, at a subsidiary level, or at a consolidated level. And we also want to remember that expenses on the income statement and dividends on the income statement of retained earnings are generally showed as negative numbers. So compute the consolidated amount as you would for revenues. And so now to get to our workpaper entries, first we have to adjust for any errors and omissions. Then we have to eliminate intercompany profits and losses. As you know, when we consolidate, we only want to report revenue once, and we want to report any profits or losses as a result of operations once. So for instance, if company A owns company B and company B sells to company A, that then turns around and sells that product, maybe it adds some value, but it turns around and sells that product to the ultimate end user, then company A would, in consolidating those statements, unless we eliminate these intercompany transactions, we're going to have posted sales twice, once from B to A and then from A to the client. So we want to eliminate this, these sales and any related profits or losses in order not to have counted them twice at the consolidation level. We also want to eliminate income and dividends from the subsidiary and bring our investment account to its beginning balance. We must, if we're not 100% owner of the subsidiary, record any non-controlling interest in the subsidiary's earnings and dividends. And so, for instance, if we're an 80% owner, then that means, or if the parent is an 80% owner, that means there is some controlling interest, which used to be referred to as a minority interest. There's some 20% non-controlling interest that owns the remainder of those revenues and or profits and losses. We want to eliminate the reciprocal investment in the subsidiary's equity balances. We want to amortize fair value differences, and we want to eliminate other reciprocal balances. So now let's walk through an example. We have Pep and Sap Data. Pep pays us $176K, and so we're just talking hundreds of thousands here. So they pay $176K for 80% of SAP on 1/1/2011, when SAP's equity consisted of $120K of capital stock and $60K of retained earnings. All excess was due to unrecorded patents with a 10-year life. SAP's income and dividends are noted below. So in 2011, SAP had net income of $50K and dividends of $30K, and in 2012, they had net income of $60K and dividends of $30K. Okay, and so first we have to do a little bit of analysis. So we know that the cost of 80% of SAP, which we were given, was $176K. The implied value of SAP then, knowing that cost, that 176 represented 80%, the implied value of SAP would be then the 176 divided by 0.8, or a total implied value of SAP of 220K. We have a book value which were related to retained earnings and retained earnings and capital stock of 180K. And so if we take the difference between the implied value of 220K and the book value of 180K, we have an excess of 40K, which we are told was allocated to patents amortized over 10 years. So what we have to do is to recalculate what our net income is for SAP. And in order to do that, we've got to understand what the amortization is. So if we look below there, we see that for the patents on 1/1/2011, we had a 40K balance. They're amortized over 10 years, so we amortized 4K. This is used in 2011 worksheets for amortization expense and patents. At the end of 2011, going into 2012, we had a 36K book balance of these patents, which again we amortized at 4K in 2012, which gave us a 32K net amortization or net patent value. And so again, we used the amounts listed under the 2012 columns for the amortization expense and patents. in our Workpaper entries. All right, and so now that we've calculated what the amortization is, we need to recalculate what the income and dividend calculations yield for consolidation purposes. In 2011, we were told that SAP's net income was $50K. So we reduced that for $4K amortization related to the patents, which gives us an adjusted income of $46K. We know that PEP has 80% share of SAP. So that PEP's 80% share of the adjusted income is 36.8. The non-controlling interest or the minority interest 20% share is the remaining 9.2. We also know, or we're told, that dividends were paid in 2011 of 30K. PEP's 80% share of those dividends were 24K, and the non-controlling interest 20% share was 6K. We do the same calculation for 2012. We were given that SAP's net income was 60K. We know that the amortization was 4K, which gave us an adjusted income of 56K. PEP's 80% share of the 56K was 44.8K, with the remaining 11.2 belonging to the non-controlling interest of 20%. And then we know that another 30K were paid in dividends, which are split consistently between 2011 and 2012 at the 80-20 share, or 24 and so then we presume to continue to prepare our worksheet entries now that we've recorded these amounts. So first we adjust for errors and omissions, and that could be in just closing of the books. We find that there are errors and omissions that are reflected in the ending balances, and so we use our worksheets to clear those up or clean them up. We talked about the idea of eliminating intercompany profits and losses, and then the third step is to eliminate the income and dividends from the sub and bring the investment account to its original balance. So in this case, we see that we knew we had income from SAP of 36.8K. We knew that we had dividends, which are an increase to shareholders' equity of 24K, and we credit the investment in SAP for the 12.8K. And so again, the income from SAP, which was a reduction of retained earnings and a reduction of revenue and a reduction of shareholders' equity, the 36.8K came from calculating the 80% share, PEP's 80% share of the 46K in adjusted income we calculated earlier, and then the dividends came, the reduction in dividends, or increase in dividends, which increased our shareholders' equity, came from the calculation of PEP's 80% share of SAP's dividends claimed that year. And the net between the two, the 36.8 less the 24, represents the adjustment to the investment in SAP account, which is a reduction in our asset accounts. And so then next, for 2011, we record the non-controlling interest in the sub's earnings and dividends. And here, again, it's similar to our earlier calculations and earlier entry, as we're debiting the non-controlling interest share of 9.2, which we calculated as being 20% of the adjusted income of 46K earlier. We credit the dividends, or the shareholders' equity, for the 6K, which we calculated earlier being the 20% share of the 30K in dividends paid, and we record the net of the 6 and 9.2 of 3.2 as a credit to the non-controlling interest, which is an increase in the shareholders' equity. Then our next step is to eliminate the reciprocal investment and subs equity balances. And this we're doing, again, in PEP, and that's so that we aren't double counting assets and liabilities in consolidation. So we remove the 120K from capital stock, which is sitting in SAP's books. We remove the 60K that's sitting in retained earnings on SAP in order to accommodate what's sitting on SAP's books. And we remove the patents, which we calculated as being the difference, if you recall, earlier on. The other side of those entries are as an adjustment to the investment in SAP, which is a reduction in assets, and then we book the remaining differential to the non-controlling interest, which is a credit to the non-controlling interest, which increases the shareholders' equity. So you can see in entry number 5, what we're doing is eliminating out of the parent company, or the controlling interest company, that is PEP, the original balances that were sitting in, and that are still sitting in SAP's accounts, and adjusting those against our investment account in SAP and a non-controlling interest account. And then finally, what we do is to amortize the fair value or book value of the differentials, and that's really the $4K that we booked each month, or we booked each year as the amortization of the patents. And so that ends up being a debit to amortization expense, which increases expense and reduces shareholders' equity, and a credit to the patents account, which acts to decrease the value of patents, so that at the end of the amortization period, the net book value of the patents is 0. And then the last step is to eliminate other reciprocal balances, which we don't have any. So note that in the last chapter, all worksheet entries were prepared for the balance sheet. Here, the worksheet entries are prepared for the income statement, the statement of retained earnings, and the balance sheet. And so here we see that the worksheets as we prepared them. So we see for 2011 at the consolidated level, we see PAP's balances, we see SAP's balances, and we see the debit and credit entries that we just posted. And then out to the far right, by netting all of these amounts together, we see the consolidated balances. So for instance, we're assuming that there are no intercompany revenues, so no intercompany sales, and so we simply add the revenues from PEP and SAP to get $630K in consolidated revenues. We've eliminated the income from SAP, which SAP reported of 36.8 as a debit to the PEP's income statement of 36.8. So when we put that across, we get to a 0 income from SAP. And then we've also eliminated the appropriate amount of expenses. You can see we've added the appropriate amount of expenses, and namely it's the $4K that we amortized the patents. So we had expenses in PEP of $400, we had a K, we had expenses in SAP of $80K, we had an additional $4K of expenses related to the amortization of patents as a result of the consolidation, which gave us expenses of $480K. And then on the next line, we had this non-controlling interest share of $9.2K that needed to be eliminated. And so when we put the consolidated statements, we see that the net income for the controlling share, that is the 80% PEP ownership, comes out to be $136.8K. Then we look at the statement of retained earnings, and essentially we're doing the exact same thing. We start with PEP balances, year-end balances, SAP year-end balances. We take into account the debit and credit worksheet entries to come up with a consolidated ending retained earnings balance of $86.8K. And so on this slide, what we are seeing is the balance sheet as of 12/31/2011 on a consolidated basis. And as with our prior example for the income statement and statement of retained earnings, and the steps that we talked about, we have a column for PEP, we have a column for SAP, and those are their year-end balances. We have a debit and a credit column in our worksheet, and those are to take into account all of the elimination entries that we talked about. And then we end up with a consolidated column, which either adds PEP and SAP, and there are no worksheet entries to come up with a consolidated balance, or we add PEP and SAP and take into account our consolidation entries to come up with a consolidated balance. So what we see then, based on this, are total assets of $1,054,000 and total liabilities of $1,054,000. And so just to recap, if we take a look at the income statement, we see that we have revenues. We were told that there were no intercompany transactions, buying and selling between the units, so we don't have to worry about eliminating any of that. We see on our next line that income from SAP is eliminated because we're counting that in in the parent company consolidation, we don't want to double count it. We have expenses which are combined to match the combined revenue, so we don't understate expenses, and then we have an additional $4K of amortization related to patents that are added, and then the non-controlling interest, which is proportional to PEP's income from SAP, since PEP uses the equity method, and that shows we got 36.8 times the fraction 0.2 over 0.8 to get to 9.2K of the non-controlling interest, which again gets us back to what we had looked at originally, and that's that the net income of the controlling share on a consolidated basis would be reflected as 136.8. And so here again we look at retained earnings. So we have beginning retained earnings of 10K for PEP and 60K for SAP. We reduce or eliminate the 60K in SAP so that we don't double count those. We add the net income that we previously calculated. We deduct the dividends and adjust for the split of SAP dividends, the 24/6 or the 80/20, to get to an ending retained earnings balance. If we take a look at assets, we see that the investment in SAP is eliminated. Patents at the start of 2011 were 20K and the current amortization is 2, so they are 18K at the end of 2011, and then the total is calculated in the consolidated column. And there again we see we've got $1,054,000. And then finally we look at the liabilities and equity, and we see that SAP's capital stock is eliminated, so that all we have left is Pep stock at the end of the year. The retained earnings are not calculated across the row, they are taken from the statement of retained earnings, and that the non-controlling interest at year end is proportional to PEP's investment in SAP, and so that's 94.4K times 20 divided by 80, which gets us to the 23.6. And so now let's move on to the consolidated work papers in subsequent years, that is 2012. And so this should all look familiar to you. We've got the cost of 80% of SAP was 176K, the implied value of 88K divided by 0.8, which gives us the 220K, and then a book value of 180K, which is the 120 in their capital account plus the 60K in retained earnings to get us back to an excess paid of 40K, and which are allocated to patents. And now let's focus on the bottom part of this slide where we see that 2012 SAP's net income we're told was 60K. We have to adjust it for the 4K amortization of patents to get to an adjusted income of 56K. When we split that 80/20, that says that 44.8K of that SAP's income belongs to PEP and 11.2K, or the difference between 56 and 44.8, belong to the minority or non-controlling interest. And then we are told that dividends of 30K were paid, and so again, based on an 80/20 split, we get 24 to PEP and 6K to the non-controlling interest. And so we walk through our steps again for the preparation of our worksheet entries. Adjust for errors and omissions, there were none in 2012. Eliminate intercompany profits and losses, there were none in 2012. And eliminate the income and dividends from the subsidiary and bring the investment account to its beginning balance. So in order to do that, we debit the income from SAP, which is a reduction to revenue and a reduction to shareholders' equity. We credit the dividends, which is an increase to shareholders' equity, and we credit the investment in SAP, which is a reduction to our assets of the difference between the two, or 20.8K. And then our next step is to record the non-controlling interest in the sub's earnings and dividends. And so we calculated the non-controlling interest, that is the 20% of the $30K that was paid, to be $11.2K, which is a debit to the non-controlling interest share, or reduction in shareholders' equity, and we credit dividends for $6K, and then the difference between the $11.2 and the $6K is the non-controlling interest portion, which becomes a credit, increasing shareholders' equity. And you'll see for step 5, we're eliminating the same reciprocal investment in subs equity balances by debiting the capital stock, which is what SAP had as its capital stock balance at the date of acquisition, by debiting retained earnings for $80K, which is what the original balance plus the 2011 earnings ended up being, to get us to $80K. And then we're debiting the patents account for $36K. Then the offset, or the credit side of this, is an investment in SAP, a credit to the investment in SAP account, which is a reduction to assets of $188.8K, and then a non-controlling interest credit, which increases our shareholders' equity of $47.2K. And so our next step is to eliminate the investment in SAP. And so, as you recall, entry 5 eliminates the investment in SAP and establishes the non-controlling interest as of the beginning of the current year. And so, in order to get to the adjusted value of SAP at 1/1/2012, we start with the implied value, which we calculated earlier as being $220K. We add the increase in retained earnings from acquisition to the beginning of the current year, and so that increase, or the change between 2011, or as a result of 2011, was 20K, which is the 80K in retained earnings less the beginning balance at 2011 of 60K. And then we reduce this amount by the amortization of the patents for all prior periods to get us to an adjusted value of SAP at 1/1/2012 of $236K. And so 6 and 7 are similar to our prior entries. We want to amortize the fair value of the differentials, and that's amortization expense of $4K, and a reduction to our patent account of $4K as a result of that amortization. And then we have to eliminate other reciprocal balances, and that ends up being the notes payable to PEP of $20K against the notes receivable from SAP of $20K. And so this is similar as to what we saw earlier with respect to the PEP's 2011 worksheet balances. You recall, for the year ended 12/31/2011, we had the revenues, income, from SAP, which was eliminated. We have expenses which were adjusted to get us. We also would take into account the non-controlling interest share to get us to net income for the controlling owner of $156.8. Then we had our statement of retained earnings, where we eliminated SAP's portion of the combined retained earnings so that we end up with only PEP's retained earnings of $86.8. We add the net income of $156.8 above. We deduct the dividends that are calculated and get to ending retained earnings of $153.6. And so finally, we look at our balance sheet of 12/31/2012, and this looks very familiar to what we did in 2011. We start out again, PEP column, with the opening or the closing balances on PEP's general ledger, SAP's column with the closing balances for SAP's column, and then we have our debit, credit, consolidation entries, and these all net across to the consolidated reported total. And you can see that these entries are very similar to what we did in 2011. They're just based on the calculations we were given for 2012's net income and dividends paid. So take a look at these and compare them to the elimination entries that we just talked about for 2012, and make sure that they make sense to you where the numbers are coming from. And so now let's talk about errors in the work papers and what may cause those and how do we find those. And so most errors made in consolidating the financial statements will show up when the consolidated balance sheet does not balance. If this balance sheet fails to balance after recomputing totals, we should then check individual items to ensure that all items have been included. Omissions involving the non-controlling interest share in the consolidated income statement and non-controlling interest equity in the consolidating balance sheet occur frequently because these items do not appear on the separate company statements. We check the equality of debits and credits in the workpaper entries by totaling the adjustment and elimination columns. Although proper coding of each workpaper entry minimizes this type of error, many accounts prefer to total the adjustment and elimination columns as a regular workpaper procedure. And so GAAP requires firms to provide at least summary disclosures regarding the allocation of the purchase price of an acquired subsidiary, especially as related to acquired goodwill and other intangible assets. Generally accepted accounting principles specifically requires firms to disclose in the year of acquisition the fair value of the acquired enterprise, a condensed balance sheet showing amounts assigned to major classes of assets and liabilities, and the amount of purchased research and development in process acquired and total amounts assigned to major intangible asset categories. GAAP further requires that the amount of goodwill be shown as a separate balance sheet line item, assuming that it is material. Pat, as an example, so let's walk through an example where we have excess allocated. So Pat acquired its equity interest in Sol on December 31, 2011 for $360,000 in cash when Sol's shareholders or stockholders' equity consisted of $200K capital stock and $50K in retained earnings. So this price implies a total fair value of $400K for Sol. That is $360K divided by 90% ownership equity that was acquired. On that date, Sol became a subsidiary of Pat. And so with respect to book value, we know that inventory, land, and buildings with a 20-year age were undervalued by $10K, $30K, and $80K respectively. Equipment with a 10-year life was overvalued by $20K. Sol's income and dividends for 2012 were $60K and $20K. At year end, Sol has dividends payable of $10K, which Pat has not yet recorded, and there's a $20K cash in transit balance from Sol to Pat for a note. And so this gives us the analysis that we have to perform at acquisition. So we are told that the cost of 90% ownership of Sol was $360K, which we are able to, by inference or implication, derive an implied value of Sol of $400K, and we're told that there's a book value of $200 plus $50K, which gives us an excess of $150K, and a non-controlling interest of $10K of the $400 implied value of $40K, and then we're given the amounts that are allocated of the price allocated to inventories, land, building, equipment, and the remainder going to goodwill based on fair values. And then beneath here we see the unamortized balances at 12/31/2011. The amortization is calculated in 2012, which gets us to the unamortized balances on 12/31/2012. And so we look at this and perform the same sort of analysis that we did earlier on, where we see that Sol's net income was $60K in 2012, less the amortization that was calculated of $12K to get to an adjusted net income of $48K. If we take Pat's 90% and the 43.2 with the remainder going to the non-controlling interest 10% share or 4.8K of the 48K, and then we also allocate Sol's dividends of $20K based on a 90-10 share respectively. So here now we adjust for errors and omissions. And in this case, we need to then debit the dividends receivable, which is an increase of assets of 9K, and reduce the investment in SOL, which is a decrease in assets of 9K. We also need to adjust for the 20K cash in transit, and the offset to that was the notes receivable from SOL of 20K. So that's the first step. Then we eliminate intercompany profits and losses, and we're not told that there were any of those, so we assume there are none. And then the third step is we eliminate the income and dividends from the subsidiary and bring our investment account to its beginning balance. So that ends up being, in order to perform that step, the 43.2K of income that's attributable to Pat, of 43.2 is a debit to income from SOL, so that reduces revenue, reduces shareholders' equity. We increase the dividends for 18K, and we increase the investment in SOL. We decrease the investment in SOL, which is a reduction to assets of the difference between the two of 25.2K. The next entries consist of recording the non-controlling interest in the subs, earnings, and dividends. So the non-controlling interest, that is the minority interest share of dividends, are 4.8, which are reflected as a debit in Pat's books. For non-controlling interest share, they end up being a credit of 2 to Pat, and then a credit to the non-controlling interest, which increases shareholders' equity of 2.8K. And then we eliminate reciprocal investment and subs equity balances. And so again, what we're trying to do here is to get rid of any duplicate counting. That's by having shareholders or capital stock and retained earnings amounts in Pat's books and on SOL's books, which then end up double counting in consolidation. So we debit the capital stock account as a reduction to shareholders' equity. We debit the retained earnings on Pat's books, and we debit the unamortized excess, which is an increase of 150K, and then we credit the investment in SOL of 360K, and using the remaining offset of 40K going to the non-controlling interest credit of 40K. We then allocate the unamortized excess according to the beginning of the year balances. And if you recall, we calculated these earlier on, and this just gives us the journal entry we make to record those beginning of the year balances that were calculated in our previous slide. So they go as debits to cost of goods sold, to land, to building, and to goodwill, with the credit offset going to equipment and unamortized excess. And then finally, step 6 amortizes the fair value, book value differentials, where we've got the depreciation of the buildings at 4K, and the depreciation of the equipment at 2K, and any other reciprocal balances, and we had those of dividends payable as a result of having the dividends payable on the books at the end of the year, which are offset against the dividends receivable account. And this simply gives us the worksheet for 2012 that under this example, and how it would look after we have made all the correcting entries, prepared all the elimination entries and all the other worksheet entries to get to consolidated net income for the controlling share of 153.2 and ending retained earnings for the controlling or Pat company of 173.2. And so here we see the balance sheet as of 12/31, and it's the same scenario. We've got our Pat's balances, our ending balances, SOL's ending balances. We've got all of the Workpaper adjusting entries that we previously calculated that get us over to a consolidated amount, which amount to total assets of $1,097,000 and total liabilities of $1,097,000. And you should be able to, going back through each of the calculations we did in this example, and all of the entries that we used to book the results of those calculations, you should be able to see how they are pulled into the debit and credit columns here to combine with the ending year balances of PAT and SOL to get to a consolidated year-end balance sheet. And so we prepare the consolidated statement of cash flows from consolidated income statements and consolidated balance sheets, rather than from separate parent and subsidiary statements. With minor exceptions, the preparation of the consolidated statement of cash flows involves the same analysis and procedures that are used in preparing the statement of cash flows for separate entities. And so here we're just reminded that at the very bottom also we want to look at items specific to companies with subsidiaries and equity investments, and be careful to include those in our analysis and in the preparation of the consolidated cash flow so that we don't double count certain transactions. And so also you'll recall from your prior accounting classes that the statement of cash flows includes essentially three areas. That is investing cash flows, financing cash flows, and operating cash flows. So let's talk a little about what's involved with each of those different areas. So when we're accounting for investing cash flows, we want to be sure to include cash acquisition and or disposal of subsidiaries and the impact of those on cash flows, and we want to include cash acquisition and or disposition of equity investees. When we're talking about the financing cash flows section, we want to include cash dividends paid to non-controlling interest. And these are items that are specific to consolidated statement of cash flows that you wouldn't generally have as a concern in preparing each of the other parent or subsidiary statements of cash flows individually. And then finally, with operating cash flows, you'll recall that we have the direct method and the indirect method. And with the direct method, we include the cash dividends received from equity investments. And with the indirect method, we start with the controlling share of net income, we add the non-controlling interest share, and then we deduct the excess of equity method income over cash dividends received from equity investees. And so this concludes Chapter 4. Please move on to reading Chapter 5, which talks about intercompany profit with respect to inventory transactions and how those are handled. And then if you move on to Chapter 6, and Chapter 6 deals with intercompany profit with respect to transactions involving plant assets. And so each of those in the consolidation process involves certain specific accounting requirements and GAAP treatments. So please move forward with reading those chapters. And thank you.